Let's talk about a number that feels both huge and somehow still within reach: $100,000. But for most people, it's a finish line they just never cross. So in this explainer, we're going to break down exactly why that is, and way more importantly, how you can be one of the few who actually makes it through the gauntlet. So let's just kick this off with a pretty shocking statistic. 3/4 of people, that's 3 out of every 4, will go through their entire working lives and never stack up $100,000 in actual wealth. And I'm not talking about the equity in your house. I mean real liquid wealth sitting in retirement or investment accounts. Just let that sink in. That is the reality for the vast majority of adults. And this, of course, raises the big question. Over a 40-year career, even someone making a pretty modest salary will see over $1 million pass through their hands. So if all that money is coming in, where does it all go? Why do so many people's net worth just kind of hover right around zero for decades? Here is the absolute most important thing to get. Reaching that first 100K, it's not a math problem, it's a psychological one. It's basically a series of mental traps that are designed to keep your net worth low, and most people fail without ever even knowing they were being tested. So we're going to walk through the 4 biggest psychological traps that keep people stuck spinning their wheels. The cool part is, once you see them, you can avoid them. Let's dive into trap number 1. First up is lifestyle creep, and oh man, this is the big one. Okay, picture this. You get a big promotion, comes with a $15,000 raise. Amazing. But what happens next? Almost like a reflex, you think, I can finally afford a nicer apartment. Boom, there goes $4,000 a year. And I definitely deserve a better car. Poof, there's another 3 or 4 grand. You start eating out more, you subscribe to a few more things, and before you know it, that entire raise has been completely swallowed up by new, higher monthly bills. You're working harder, you're earning more, but your ability to actually build wealth hasn't budged one bit. You've just upgraded your treadmill. Your net worth is still stuck at zero. It's just a much more expensive version of zero. All right, the second trap is what we call the payments mentality. Our entire consumer economy is built on this. I'm serious. Companies know that if they can get you to focus on a low monthly payment instead of the total price tag, you will buy things you absolutely cannot afford. Just think about it for a second. How much does a new car cost? If your brain immediately goes to the monthly payment, you've been caught by this mindset. Yeah, $412 a month might sound manageable, but you're forgetting you just chained a $35,000 anchor to your finances for the next 7 years. Okay, let's move on to trap number 3, and this might be the most destructive of them all. It's the belief that you can always start investing later. We all tell ourselves this story, right? I'll get serious when I get that next raise, or once I figure out the market a little better. But later almost always becomes never, and that delay is just incredibly expensive. This chart just shows the raw, brutal power of compound interest, which is all about time. If you invest $500 a month starting at 25, you could hit $100,000 by your mid-30s. Not bad. But if you wait until you're 35 to start, you'd only have half that by your mid-40s. We're talking about the same money, the same investment, just 10 years of lost time cuts your results in half. It's brutal. And that brings us to the final trap. And this one is a fundamental misunderstanding of what wealth actually is. It's called asset confusion. Most people really think that their expensive car or their designer wardrobe are assets. They are not. They are liabilities. The definition is so simple. An asset puts money into your pocket. Think stocks, bonds, index funds. A liability takes money out of your pocket. That's your car payment, your credit card debt, the financing on your furniture. Wealthy people buy assets. The middle class buys liabilities that they think are assets. It's a huge difference. This is the classic story of the tortoise and the hare, right? The hare, person B, earns a lot more, lives this flashy lifestyle with a BMW, but has nothing left to invest. The tortoise, person A, lives a little more modestly, but is consistently buying assets every single month. After 10 years, who do you think is wealthier? It's not even a contest. The slow and steady tortoise is dramatically wealthier. It's never about what you earn. It's always about what you keep and grow. So we have seen all the traps that are designed to hold you back. Now let's talk about the prize. Because if you can navigate that gauntlet, something genuinely magical happens when you cross that $100,000 threshold. It really is the first financial milestone that truly matters. I want you to think about building wealth like an old-school arcade game. For the first few years, you're just feeding it quarters. You're putting your money into your investment account month after month, and you really don't see much happening. It honestly feels like you're just losing money. But then, You cross a certain point, you've fed the machine enough, and all of a sudden, it starts spitting quarters back at you. At first, it's just a few, and then it's a lot. That is the moment your money starts working for you. That is the magic of the $100,000 mark. So what does that actually look like in real terms? Let's use a real concrete number. $8,000.
At a pretty average 8% market return, a $100,000 portfolio generates about $8,000 a year in growth, all by itself. That's over $660 a month that your money earns for you while you sleep. The snowball has officially started rolling downhill.
The legendary investor Charlie Munger said it best. Getting to that first $100,000 is a serious challenge. It's all about discipline. But once you're there, getting to $200,000 is actually easier, and it's faster. And getting to $400,000 is even faster than that. The hard part is over. The rest is just math.
Okay, so you understand the traps, and you understand the prize. Now let's talk about the how. Here is a simple 4-step blueprint to get you on the path to your first $100K.
First, you have to destroy any high-interest debt, especially credit cards. You simply cannot outinvest a 20% interest rate. Second, build a buffer, a $10,000 emergency fund so that a flat tire doesn't send you right back into debt. Third, automate your investing, have the money transferred to your investment account the same day you get paid before you can even touch it. And finally, here's the accelerator. Try to live on significantly less than you make. The wider that gap is, the faster you're going to sprint to that finish line. I want to leave you with one last thought. And it's a little bit counterintuitive. It's about what it actually feels like to build wealth. The truth is, the road to your first $100,000 is boring. It's really boring. It's driving a paid-off car for 8 years. It's packing your lunch. It's setting up that automatic transfer every single month and then just not touching it. There's no big thrill. It's not exciting. But that slow, steady, repetitive process is what actually works. Ultimately, the entire consumer economy, pretty much every ad you see, is built to keep you spending, to keep you on that financial treadmill. Getting to your first $100,000 is an act of rebellion. It's the decision to finally step off. So the only question left is, are you ready to start?